I've discussed in the past, and this is going to ring true, and I'm sure a lot of you are going to kind of like tap yourselves on the shoulder about this. Prices move along the line of least resistance, and the news always falls along the line of least resistance. The market has been going down, so the Fed news was considered bearish. Very simple. End of broadcast. Nah, I'm just joking. All right, so let's get a little bit into the Fed and why the Fed setup today wasn't very good. One, I always say that it's always safer to be lower into the Fed. That is not what happened. We rallied hard yesterday, and then again today, we rallied into the Fed, so this was sort of sell the news, number one. Number two, we rallied into some resistance. That was troubling. Number three, a lot of you mentioned before Apple and Boeing. So I don't want to take too much of a detour. I guess we'll take a little detour into Apple and Boeing. Both of those are, as we know, Dow components, S&P components, and obviously Apple is the biggest part of the S&P. Sorry, not the S&P 500. The Nasdaq 100. So Apple initially had I believe it was a pop and flop. I'm just pulling up the chart. Now, it actually initially went down, then went up and got to the 103 resistance. An old breakout in Apple had been 103.74, and then basically after that, the commentary on China wasn't good, and the stock went lower. It's into a pocket right now. The flash crash low was 92, so it's still kind of technically okay as long as it doesn't break there. But I think we are going to break there. I think we're actually going to go lower. I've been looking for 85 and potentially 75 if the market really weakens. Anything below 100 to 103 now is going to be considered, 103.5 is going to be considered vulnerable in Apple. I like put ratios. The problem is there's not that much IV. With Apple, I like at least $3 to $6 worth of spread. $6 we will never get now because of the earnings being reported already, unless Apple starts really dumping and then the IV gets jacked. But at least $3, we're not able to get that, so you kind of have to play it with just flat-out spreads. I don't get commercial breaks, so yeah, I drink a little water on air on occasion. The 90 puts in next week's expiration had a lot of volume. That, to me, would make a lot of sense if they get challenged. Boeing. So here's the problem with Boeing. We know a couple of days ago they mentioned that they were going to cut their 747 orders in production in half. And we also know, at least we know because I've told you so, that the durable goods orders are largely reflecting of Boeing, and we are going to get a read of that, I believe, tomorrow morning. They should be atrocious. So Boeing here is kind of at the lower end of range. It had had a bit of a bull flag for a while, which broke on the flash crash, rallied to a lower high, and now we are selling off again and getting close to that area. There was a gap fill around 111. There was a reference price level I have in my chart around 107. So we're going to have to see here if this 115.14, that was the flash crash low, holds or not. It looks like today, did we eclipse it? Yeah, we got a little bit below there, 115.02. So basically 115 has to hold. If anything below there, to me, looks really kind of toppy, and we could see potentially, this is really annoying, I'm trying to pull up a 10-year, it keeps like crapping out, there we go, 10-year daily. I'm going to have to do a little bit more analysis on Boeing because I don't really handle the levels with that quite regularly. But like I said, I see some prominent gap fills around the 111, and then there's another one down around 88. I don't know if we're going to get that low, but in this tape, it really wouldn't shock me. So I'll cover Boeing a little bit more in the weekend review with some more helpful levels with Fibonacci. But in the meantime, the important point that I want to make with Boeing is that the durable goods orders are going to be affected. And anyone who follows me, who has followed me for a while, knows that I look at a few important things for the Fed. The jobs, which we're going to address in a minute when I finish my Fed critique analysis, which I will do right now. The GDP, which we're going to get a read on Friday. ISM, both the service and the manufacturing. The PMI, the durable goods. Then, of course, the dollar and of the stock market. And oil is, yes, that is an important one, but that's not one of my Fed keys, although we will discuss that as well. Anyway, let's get back into the Fed. So why did we go down on the Fed minutes? They were dovish, right? Everyone said they were dovish. I have a little bit of a different read of the Fed minutes. I read them multiple times, and I took down some notes when they were being announced. I went through it. They were saying that there was no longer a balanced outlook, which is a little bit dovish, although that is a major downgrade of both the global and the domestic economies. They're monitoring global developments, meaning they realize that China is melting down and so on and so forth. They say the labor markets are improving, which is really what the Fed seems to keep keying off of, this one statistic. And I think I've proven that statistic to be quite dubious in the past, and I will do so right this moment. The Fed keeps talking about this low this high employment and the low unemployment number. If you're unemployed long enough, you're basically no longer counted in the statistic, and that's very evident by the labor participation rate, meaning the percentage of Americans working, which is the lowest since 1977. So, yeah, the last jobs number, which everyone was very excited about, was a lot of part-time work, young kids getting holiday jobs, waiters, waitresses, bartenders. In the summer, I was amused by the carnival ride operators. The numbers are not good. The job quality is not good. The Fed has acknowledged that the amount of, the wages are not fantastic. They've been minorly upticking, but they're really pretty pathetic. So the jobs outlook isn't good, even though the Fed is in this fantasy delusion land that the jobs outlook is good. They say inflation is slowing. That to me is, that's maybe one of the largest understatements I've ever heard. The inflation is slowing. Oil is crashing, as we all know. Every commodity that I think isn't nailed down is crashing at this point. And they keep using this term. They used it again, this transitory. I'd like to know what isn't transitory at this point. Bernanke seemed quite prescient when he used the transitory term, and I think Yellen just looks a little bit dumber when she's using it because it seemed to work out better for Bernanke. Maybe it was by luck, or maybe the guy was just smarter. She keeps using this word transitory. They used the word transitory with oil when it was in the 50s and 40s. It's barely holding in the 30s. With regard to oil, though, and a little bit of a sidetrack, I did like the price action the last two times it got bad news. We got numbers from we had a preliminary number last night of 11 million barrel build, and it turned out to be only 8 million. So the API number turned out to be overly bearish, and the Department of Energy, the DOE number, was a little bit, less bearish. That's still a pretty big build. And I liked that the last two times we've had builds that are kind of chunky, the initial knee-jerk was down, and then we finished green, which is good. It looks like we're back over 30, over 32. Constructive. 33.20 and 37 are kind of the next important levels. We'll see if we have some runway to get up there. I wouldn't even be surprised to see this thing get back up to 40. It's been so hated and so shorted, and so many people, I don't know anyone who likes oil at this point. Just everyone who loved oil and had to buy it up at the highs, now everyone hates it at the lows. The consensus is that it's going to $20. I've heard even lower. Unfortunately, there's not that much here to reference with the chart below the 33.20. I mean, 25, 26, which I mentioned, and then 17 and 10. Will we get that low? I mean, I guess it's conceivably possible, but I mean, the last time we were down that low, we were in the 90s, and China and India weren't really the kind of economies they are now. Plus, there is a dollar value of money. I understand there has been a ton of supply heaped onto the market, and you keep hearing these bulls who come out and talk about how great the economy is, keep citing that. But the truth is that it's a combination of demand, increased supply, and lower demand. Not a good combo, particularly together. You have a lot of companies. I don't want to say shitheels because it's a little bit too strong of a term, but maybe I will. They're shitheel companies that took out a ton of debt, and they basically needed oil to stay above $70 a barrel, some of them $40. They had different production costs, and those chickens are coming home to roost. They are... I think the last video I introduced to the stream the mouse and the bell analogy, where you put a mouse under a glass or a bell, and at first their breathing is normal, but as they as they deplete the oxygen, they start breathing harder and harder, and the more they breathe, the more they're speeding up their own deaths. So that's sort of like what's happening with oil. These companies are pumping and pumping to meet debt payments, but as they pump more and pump more, they're further and further depressing the price of oil. So that's my view on what's happening there. How far that will go, I don't know. We're gonna see. There's gonna be some bankruptcies for sure. There will be blood, right? In the prescient words of Daniel Plainview. If you know that movie, cap tip. Anyway, that's the story with oil. There's a little more with the Saudis and the Iranians coming on with more supply as well, but a lot of the domestic production has caused this problem. They are cutting rig counts, but I don't think that they are cutting them quick enough. Let's see. They talked about the households and the spending. I wrote that it was downgraded, but it looked like they were pretty complacent about it, in my view, the Fed. They know that internet and business investment is slowing. That the trade imbalance is sort of worsening. Of course, that's their hat tipped to the stronger dollar. So this is why the market was down. Submising that whole piece of information, it basically is saying that the Fed says that they were aware that there were. I'm now summarizing. I'm paraphrasing. We are aware that there was going to be market turmoil coming off the lower bound, but we are within our tolerance levels. So it's okay. We're going to stay the course. That is not what the market wanted to hear. The market wanted to hear that they are not happy that the markets are down and that they have reached their tolerance point and that they are going to reverse their rate hike, which I've proposed and I think now has been confirmed is a policy error. So that is not the case. The Fed is willing to take some more pain, and we will have to take more pain, or at least the stock market will have to take more pain. That is basically my summation of what the Fed said. So they are not going to be, riding to the rescue here anytime soon. I believe that I don't think that they're really very hawkish in the bigger picture, but I do believe that they don't understand that they raised interest rates into a slowing cycle. We have a few pressures on the economy as they are. We are in a down cycle, number one. The economy is like a sine wave. It goes up and down. We are in a down part of a cycle. We also have structural problems which will not be fixed very quickly with the business cycle. The Fed doesn't know how to combat that very well. The problem there is technology. Amazon, Facebook, Google, you name it. Even in restaurants, I give this example. I haven't given it in a while, but I was at a movie one night. I left the movie, I went into a pizzeria Uno, and I didn't even have to really order with a person. At least the appetizers were digitized by now. I don't really eat there very often. The food is kind of crappy. But The manager assured me that very shortly you'd be able to order your entrees. So those waiters and waitresses jobs that keep making up these employment numbers are probably going to become slim pickings too at some point. So that's the issue there. So it's really a matter of tolerance. That's really what this is going to come down to. You're not going to hear this from the media because they don't know what the hell they're talking about. They are just always caught up in their own neither world. The truth is that the Fed acknowledges is that things are weak, but they're not weak enough for them to change course. This is completely wrong. They should have never hiked in the first place. You don't hike in, they basically are trying to tighten money into an economic slowdown that is very troubling. So that's really the Fed. That's the Fed. That's the reason why it was down. And the fact that we had rallied ahead of there because people were, believing the Fed was going to ride to the rescue today, were quite delusional and got themselves involved with bad trade location, and the rug was pulled out from under them. And you also had, the rates are trouble. Anyway, let's get into some of these names that you guys wanted to talk about. And where did I write them? I think I wrote them. Wonderful. I'm using oh no, this was the one. Here we go. Nope, those weren't today's. Wonderful. Here we go. This is today's. All right. So first and foremost, people were asking about the bank stocks. I saw Goldman Sachs, Bank of America, all of these stocks mentioned. Now, the problem with these stocks, Goldman Sachs, number one, looks like a Head and Shoulders, and it looks like it had a neckline breakdown and is probably due for some type of a check back. Wow, that's actually quite bearish. I hadn't noticed that. I don't look at this chart all that often. 172.32. What was this reference low? 167. So between 167s and 172s to me looks like it would be a good short for a right or right out if there is a bounce. If it doesn't work, just stay out of the way till the downtrend line, and then that'll probably set up. But I do believe that we do have, this is as clear as day, a Head and Shoulders breakdown. We're below the neckline. We're into some reference lows down here, so it wouldn't surprise me if there was a bit of a bounce in the 151s. Primary trend comes into play around the 50% fib, which is actually quite interesting, around 133. I'll cover this one in the weekend review because this one is going to be quite interesting. I think that there's going to be a measured move to the downside. This looks like it could be a 3-wave pattern, and we're only in wave 2. So I'll cover this one in more detail. Follow up with me in for the weekend review on Sunday. I hate to be a bit of a tease, but it's one I should cover. This pattern is very noteworthy. Bank of America, the same problem. It's not a Head and Shoulders. It was just a sideways consolidation range. It really broke down below 1460. Wouldn't surprise me to see that get a bit of a check back. But the problem really is, let's just get it out there. These stocks need interest rate hikes to rally. I think that the Fed is probably unlikely, based on what the Fed funds rate says, that they're going to do future hikes, whether or not they like it or not. They still their statement today, by the way, also didn't take the March hike off the table, which also the market didn't like. I think the market kind of wanted them to say that we're going to be on hold, and we didn't get that. They basically just said they're staying the course, which means March is still very much in play. However, the market isn't pricing that in. It's sort of a game. This is sort of a game of chicken. The bank stocks, to me, they had been a little bit stronger into the release, but they are, and Bank America still closed a little bit green. But I do believe that these stocks need rate hikes. I've said it before, they don't have earnings profiles like they used to. They've been regulated into oblivion. If you want to play the interest rate game, do it with the insurance companies. Travelers, Met, all of those are much, AIG, all of those are probably better bets than the banks. The other issue with the banks that I don't think is being talked about enough are two things. One, I think people are worried about counterparty risk to Deutsche Bank. They have a huge derivative book which is in the process of melting down. If that hasn't been, headline news yet, the ticker isn't up on the on the TV yet, that could be the next kind of big fiasco. I've heard people talk Lehman. I don't necessarily know that that isn't a good comparison. It very well might be. I don't think that the government will let Deutsche Bank go, but I actually don't think that the German government will allow that. But I do think that it will be enough to scare the bejesus out of the markets, and there will be, the fear of the counterparty risks. Additionally, weighing on the banks, as if they didn't need any more, is their own derivative books and their exposures to loans to those shitheel companies that I mentioned, who are blowing up because of the low price of oil. Banks are going to probably have companies toss them the keys to their rigs or whatever, and they're going to be in the oil business. So that's really what's weighing on the banks. Facebook, probably my favorite stock of all time, maybe I want to say. They had good earnings. I'm curious to see where it is right now after hours. It's into some resistance here around 102, though. Let me just pull up the daily, 9-month daily. It had some reference lows around 100.47 and let's see. Yeah, we're close to this 102 area. There's a descending 50-day moving average. There's also a downward sloping regression line that I've drawn in around 102s. That's also, believe it or not, a 61.8% Fibonacci retracement from the 110.65 peak to the 89.37 low. That's 102.52. It's also the opening. It may get 103, but that is the opening gate to a volume distribution. I would be looking to book some profits there. I am, however, and we are in 103s right now, actually. I'm just looking at the price. I am longer-term bullish on Facebook. I think that it is now a buy-the-dip stock as long as you hold above the 99.24. Anything below there, to me, gets a little bit iffy. But I do, I'm sure the upgrades are going to come. I'm bullish on, we have to see, by the way, we've had these pops before in Netflix, and those gains were given up. We have to make sure that Facebook is going to hold the line, so to speak. I think that Facebook is probably going to be a little bit different than the other FANG stocks because, one, the chart pattern is better. It's not that far off the old all-time highs. I think that their business is growing very, very rapidly. I was comparing the growth rate of Google and Facebook, and it's just like off the charts now in terms of Facebook, in terms of their market share take and their accelerated revenue growth. It's actually quite impressive. So I think that now it's 105. I mean, yeah, this stock is just probably going to keep going for a while. They had mentioned before in the past they were having foreign currency risks, but they didn't really stress that from what I saw in the preliminary look. I have to do a little bit more work on the quarter, but it looked really, really solid to me when they first printed. It was a bottom line and a top line beat, and I know they are growing very, very quickly. So Facebook is, to me, still a buy the dip stock. I'm a big fan of Zook. I know a lot of people have doubted him for a while, but I think that his acquisition of Instagram is going to prove to be one of the big buys of all time. I mean, the stock's just soaring after hours. Wow. Amazon. So I've been interested in buying Amazon on a dip. I've been looking for the shake and bake type of play. I guess you got enough of that today in Facebook. Amazon, I would have liked to have seen a primary trend touch, although now with Facebook being up this much, you're probably going to get a rally in FANG tomorrow. I'm just looking after it. Yeah, it looks like Amazon's already up $10. That is a bummer. But I do think that they're going to have a pretty good quarter. I would be probably interested in selling some out-of-the-money puts as a long proxy. The trend line, if it were to happen on the earnings, would take you down to the lower 500. So if you want to sell those puts, that to me is probably the safer bet. So someone asked about Twitter. So here's the problem with Twitter. Twitter is sort of like, Facebook is everything Twitter isn't. They are monetizing, they're growing their user base. The big problem with Twitter is that they're monthly active users. Those numbers have been either stagnant or in decline, which is very, very bad. The problem for Twitter is that they are still valued with a growth multiple and they have no growth. So until that issue changes, with 2 solid back-to-back quarters, the stock is likely going to be under pressure. It's getting kind of, I want to say it's getting kind of cheap, but it still could get even cheaper. They really have to present them, some product changes. I think that the hiring a couple of weeks ago of a diversity director, to me, was just like, I wanted to throw up hearing that. They need to focus on building their business, not, being politically correct. So, can Twitter ever recover? The answer is it can. I just don't necessarily know that it will. I do think at some point that this stock will be a takeover by someone. I just don't know that it's not going to be from single digits. So, on an enterprise valuation, the stock isn't that expensive, like compared to some of of its peers, although now that we've had these unicorn blow-ups, it's becoming less and less, I guess it's becoming less and less cheap. But, there's going to have to be some value to someone with this stock. I just don't know it from what price. Like I said, I don't expect their quarter to be any great shakes. The more it sells off probably into the quarter and the weaker it's probably, the safer it is. But, they have some problems, and that, Jack Dorsey really has to, at this point, it's show me the money. That's really what it is. You ever see that Jerry Maguire? It's show me the money. And until he shows Wall Street the money, they are going to show him the middle finger by selling his stock. And they've been doing that with Square as well. I think it was a really huge mistake. I tweeted him. They chose to ignore me. I said that the street, until he fixed Twitter, the street was going to be tough on Square, and they have been. The stock is like barely holding on to $9, and there's I expect them to both to stay under pressure until they get that act together. Someone asked about the TLT. I'm just going in order that I wrote this stuff down. Let's actually do Netflix first, sticking with the FANG story. So I had talked about there being a double top potentially in place. It looks like that call was correct. I took a lot of heat on that. People were using all kinds of expletives. I had said I thought we'd see the 115. We did. We bounced. We lost the 110s. We lost the 103.88 to 105 area. We today took out the last earnings report after hours, regular hours trading low, and the after hours low of 93.55. I think that we're going to see the flash crash low where there'll probably be some support. That's around 85. I think it was 85.5. I think we'll see that in relatively short order. I have proposed in the past, and this has not gone over well on the stream, that we would retest the breakout at $70. Primary trend, although I don't expect this to happen tomorrow, is down in the low 60s, 62s. By the time we get there, it'll probably have risen a little bit, but it really wouldn't surprise me to see the stock kind of get that low. We are still in, I consider this one wave. I want to say, I have to go through. You can make the argument that we're in a mini wave 3 here, but I really view this as one big wave here. So it wouldn't surprise me to see there be some type of another upturn. I don't think the stock is going to go straight to hell, but I do think that short term we are going to be looking at 85s and potentially a little bit lower than that. So look for that to happen. I have some put ratios on. I'm playing for that move lower, and we'll see how that plays out. Apple, I talked about. Microsoft, someone wanted to talk about. All right, so Microsoft, we know had pretty good earnings the last couple of times. The stock was up really in a straight line from 39.72 to 56.84. The halfback and roughly gap fill is in the 48s. If you could see that before their earnings, that would be wonderful, although it doesn't, their earnings, 120, yeah, so probably not going to see that happen. I'm a little bit cautious with the name just because it ran so much and because Intel and we know the PC, even from Apple, the PC numbers weren't so great. So I'm a little bit cautious with regard to Microsoft. I would be interested in buying it if it happened to get down somewhere like between 46s and 48s. I think I have a resting, let me see, I have a resting buy order in like close to 45s, 44.75 to 45. I think that area on an overshoot would be pretty good. You probably won't. I mean, the stock to me looks like it's fairly bullish still. It's corrected a lot of the misgivings. It's going to tend. I've been saying for a while here that the second mouse gets the cheese. I'd rather wait and see the numbers and not play ahead of them because, you know, if we really are at a market top, you might not get these prices back for quite a while. It took Microsoft about 15 years to get back to these levels from the last time, so I would be a little bit cautious. We are below a trend. We are into some support. It held the 50 area. It got rejected a little at the 52s. So far it's doing everything kind of technically right. If you're bullish on this, you really need it to be over 52.25 to 52.65. So I would think over there is bullish. Below there is still a little bit iffy. I'd be into it, like I said, in the mid to high 40s. eBay, so that got nailed after hours. It's been on my radar. I've been waiting for this kind of a flush to buy. It's now below channel, which is a little bit iffy. The flash crash low was 23.23, oddly 23.23, and the 61.8 is 23.45. The stock right now, the run began from the 19s. I think it was 1950. Actually, I have a resting buy order in down around there. Where's eBay? It would be under E. So yeah, we're roughly around there. So it wouldn't be surprising to see a little bit of muscle memory there. I hate that they kind of tried to bounce it ahead of the earnings. I wish it was just straight down into there. It would have set up much better. A longer term, I actually think eBay is eventually going to be integrated or bought by someone, maybe Alibaba. Hard to play that. I'll probably be interested in selling some puts on this down move or even trying to play right or right out if there's a opening low. So I'll be looking at that a little bit regular trading hours. PayPal was oddly good numbers, so I guess they're kind of sorry they did the split. Exxon. So Exxon has just been chopping around in this range. I think Exxon and Chevron, they were actually tried to be up for a while today until the market really started the down move. I think a lot of that down move, again, was because of the Boeing and Apple pressure weighing on the ETF, and the ETF selling was hurting those stocks. They're sort of just, if you're bullish and you want to kind of own them, just sell some puts as a long proxy. That's sort of what I have on. It's small. I don't have a very big position on in anything here, but I do think that those dividends are going to be safe for a little while, and if the oil rally continues, that will be good for those stocks. Boeing I covered. Let's get into sort of the more macro stuff. I usually do that first, but let's just do SPY. You know, it's below one of the trend lines. Today was sort of it was a bit of an outside day, but it kind of closed as an inside day. You know, not the best. You know, not the best pattern today. You had a look above a 2-3 day high. We were starting to make higher highs off higher lows for the first time. I had mentioned that intraday, and now that kind of got blown out of the water, which is really troublesome. So here's my spiel. If you've watched me before, you're going to know exactly what I'm about to say. I wish I could, have had you guys write it in a sealed envelope and then see, who really knew. Fed day ranges. The range, the high and the low, are what you play against. If you can get above today's high of day, the market is a long. If you get below today's low of day, the market is a short for right or right out trades. And you can use, bodies as your stops, maybe. So that's really that's going to be my analysis on all of the major indices. The SPY has basically had a double bottom now off of a slightly undercut, which is what I kind of thought would happen. We would get a bit of a rally. I really would have liked to have seen a bit of a stronger rally, and I still think it's possible, believe it or not, that we could get a move higher into the real true breakdown areas between the 197s and the 199s, maybe close to 200. That would be amazing. It seems really difficult here considering the market is so heavy and not trading well, but that would be that to me would be a great opportunity for a fantastic right out short. IWM has been sort of the pig of pigs, although today it really wasn't so awful. It was just sort of a consolidation inside range. It has a lot of excess, on that 95. I really have been looking for it to retest 85. Maybe that happens. TLT, actually, let's do Qs first. Qs, obviously we know they had a lot of weakness today because of the FANG stocks. They'll probably get a bit of a boost tomorrow because of the move in Facebook, which is frankly good. If you can take out the 104 area, and I've talked about 104, 105 in the past being important, you'll probably get a move potentially to the 20-day moving average and I think maybe the 50-day. By the time we get there, that'll be a confluence with the 50, 100, and 200. That would set up it as an amazing right out short. Let's see how that goes. Again, the Fed day range, that is what matters. Like the door test in Bronxdale, they said forget that kid, it's the door test. The Fed day range, if you were short at a break of the last Fed day range, you're very happy right now. TLT, let's discuss the bonds, and I think we'll end on the bonds. 126s have been a lot of resistance. We keep banging against that. The more we hit against it, the less resistance it'll be. I've been toying with a couple of problems, mental problems. One is lower yields and higher bond prices to me means there should be multiple expansion in the market in S&P 500. However, if we're going into recession, and I think that's really what the market was afraid of and sort of signaling today with the dumping of the FANGs, is multiple compression. So the market is sort of butting heads with those two. That's why you have these up days in FANG and then down days. The market is kind of battling it out between whether there should be multiple expansion or multiple compression. And to me, it's signaling that the market is probably going to win out with multiple compression at some point here, as long as the bonds stay strong. I think the bonds are not now staying strong because of QE, but because of fear of recession. Other countries, other people, they're putting their money here, and they're basically viewing the bonds as a safe deposit box. They don't have FDIC insurance in their own countries, so they're putting it into our bonds. When markets get squeamish, it's not so much a return on your capital, it's a return of your capital. The Treasury is probably not going to close anytime soon. Anyhow, I'll leave it at that. If you came into this broadcast late, I'm going to post the rebroadcast now on my YouTube channel. If you're not subscribed to my YouTube channel, get on that now. It's Justin Pulitzer Trades. I post my weekend review videos. I post the rebroadcasts of these videos, the Periscopes. And then I also post special edition videos from time to time. So that's the deal. If you happen to come into this later, you want to watch it again, hey, feel free. Anyway, that's my story. I'm sticking to it. I will post a little bit more about trade ideas and setups tomorrow if we have a break of that Fed day range. I think that ratios or spreads would actually work. One last thing before I leave you. I hate to be such a tease. The VIX, that is very important. One thing I will hang my hat on for the bulls today, they were able to hold the VIX below 25. They had a bit of a look below and fail below 22. If the bulls can break 22 again, I think that we'll have a bit more of a rally. If the VIX starts getting back up above 25, just be very cautious. You're probably going to see lower stock prices. And that, to me, the breadth today, like I said, really wasn't that impressive. So this wasn't like a horrific example of a decline, but Fed day range. Let's just keep it that simple. Anyhow, that's it. I'll see you guys. I'll see you guys in the Sunday video and on the stream. Cheers.